wait a second, this makes no sense. It's a fast growing business. Positive cash flow. Was Palantir getting interesting? Absolutely. This is a long-term bet. So a very popular video on this channel has been about Palantir. Now, the whole history of Palantir on this channel is very interesting. Let's pull up Palantir's chart. Now, for those of you new to the channel, I want to remind everybody that some of the things we're going to discuss here might sound confusing to start, but that's okay. It was confusing for everyone when they started, including myself, including a guy like Warren Buffett. He first said he wanted to buy a company because Ben Graham loved it. So you've got to remember that this is a process of learning. I'm not here to give you fish. I'm here to teach you how to fish, and your process will end up being different than mine, and that's quite all right. So look at Palantir here. This is the max chart. Back in February of 2021, we were criticizing Palantir. It had an all-time high right before then of $45. All right. It is currently at $6.93 with a recent low of $5.92. All right. Now, if you look back at our videos, we analyzed Palantir, and there were a lot of issues with Palantir. That was 7 or 8 quarters ago. Since then, they've now had 8 quarters in a row of positive cash flow. They have $2.7 billion in cash on their balance sheet with very, very little debt. As you can see right here, the market cap is 13.48, and their enterprise value is actually lower than that. That means there's a net cash on hand. If you bought the company today, you'd get about $2 billion in cash in your bank account, so you're paying that much less because they don't have any debt or very limited debt after taking into consideration their cash. Right? That's like you pay $5 billion for a company. They have no debt and $1 billion in cash. You essentially paid $4 billion for the company, right? All right. Now we criticized this investment saying, listen, it doesn't make any sense. At the time, it was like $100 billion value or market cap, maybe $90 billion. And we're like, wait a second, it doesn't even generate. I mean, now in the last 12 months, it's done $1.83 billion after a lot of growth. Its current price to sales ratio is 7.36. Microsoft's example is around 8 or 9 or something like that. So back then, with lower revenue and a higher market cap, the price to sales ratio was 30, 40, 50. I don't remember what the exact number is, probably higher, probably 80. And I was like, wait a second, this makes no sense. And I said at the time, I'm probably interested in Palantir around $5. Well, of course, it started to fall. As you can see from this chart, started to fall. And remember, my goal is to be patient. As I invest, I used to be an investor where I did 100% ETFs. And then as time went on, I started to dabble in individual stocks. I still recommend everybody do ETFs and dollar cost average. But as time went on, I started to understand financials more. I started to buy individual stocks. And then time progressed, and now I own 100% individual stocks when I'm invested. I don't own any ETFs. That's the process for me. But I also have multiple revenue streams. So as time went on, I can be patient here. And when you buy individual stocks, you should be patient. Wait for the stocks to hit where you want them to go. There are 10,000 stocks out there. You want to be patient for the stocks to hit the right price. Now, is Palantir getting interesting? Absolutely. Is it at the right price? I don't know, because there's still a lot of unknowns with Palantir. Let's look at their 8 pillars. These 8 pillars are ugly. Look at these 8 pillars. There's only 2 check marks here. This is not great. There's not enough data for a lot of this stuff. This is the issue. Now, their free cash flow in the last year is $200 million, which is still not a lot compared to their market cap. However, it's a fast growing business with very, very high margin. Look at this gross margin, 78%. That means for every dollar they add in revenue, 78 cents of it is going to be able to go to paying taxes and their overhead costs. As an example, Microsoft is 68%. That's pretty freaking high, guys, 78%. And they go for large contracts with governments and major corporations. I like this company. I like Peter Thiel, the guy who started it. I like a lot of aspects here. Now, the question is, what's the right price? So let's go look at analyst estimates here to see what they think. So analyst estimates they estimate they're gonna make 17 cents per share this year. Whoopee! I mean, that's nothing. But they're expecting it to go to $1.43 in the next 3 years. Now, is this correct? I don't know. Analysts tend to, it's a good way to gauge where they're looking. And they're very active with the companies and talking to them, but they're also going to go the way the stock goes. So the more the stock falls, they're going to be more conservative. The more the stock rises, they're going to be more aggressive in their estimations. Why? Because they want to make sure they make people happy and they're not too incorrect in their assumptions. Let's look at the revenue growth numbers by analysts. Guys, I mean, we're talking about some pretty big revenue growth numbers. But again, Not anything that you can sit there and say is 30, 40% a year as they're so small. I do think a company like this can grow that much. But the question is, what does it look like for the future today? Remember, the price you pay today is you have to make sure it's below the value of the company long-term. So let's go look at the stock analyzer tool. I'm going to go very, very far in the future here. I'm going to go 20-year stock analysis. And here's why. This is a long-term bet. This is not a company that I think you should go YOLO on. I'm not going YOLO. When I start to buy shares, I'm going to buy a very small amount because this is the kind of company also that could easily just have something bad happen and it goes kaput. Now, do I think it's going kaput? No. But the smaller the company, the more risk involved. We're not talking about a Microsoft or Google yet. Could it be? Sure. Data is the future. Data is today. Everybody loves data. And Palantir's goal is to take companies and take countries' data and offer them solutions on the problems they have. That's a very, very lucrative kind of endeavor. But is it for sure? No, guys, look at Tesla. Look at how Elon Musk went and bought Twitter, and that's people's excuse for why the stock fell. Is it really that? I don't know. But it's fallen 75% in the last 14 months. Now, Palantir has fallen more than that. They were at a high of $45, and in 23 months, they've fallen as low as $5.93. That's a 90% drop, almost 90%, 87, 88%, whatever the number is. But if you can find companies like this with a very high gross margin and a very high growth rate, this is where you get those multi-baggers. So what's a multi-bagger? It's a 10 multi-bagger is a company that has gone up 10 times in price. So you bought it for $10, it's 100. I recently read a great book called 100 Baggers. Loved it. And for this company to be a 100 bagger, you basically, in essence, have to take this market cap and add 2 zeros to it. So it becomes a $1.4 trillion company. Is that possible? Sure, it's possible. Is it probable? I don't know. And obviously, the cheaper the company gets now, as long as they stay in business, the more shares you buy, the more likely you are to get that kind of return. But do you need a 100 bagger? No. And we're also talking about the average 100 bagger, I think I read, took like 32 years or something like that. Maybe it was a little bit, I don't remember the exact number. But these are the things about Palantir that I want to keep in mind that I get excited about when I see these attributes that I like. I like the fact that they have a high gross margin. They're cash flow positive. They have a great balance sheet with essentially no debt on them. And they're growing their business 30, 40% a year. In the past, does that mean the future? So we're looking 20 years out. Let's say that we think Palantir can do $50 billion in revenue in the next 20 years. So what does that mean for today? They do $1.8 billion today. Basically, trust me on the math, it's an 18% growth rate, 18.1% per year for 20 years. Okay, so let's put in here 20%. Let's go here and put in 8% for a low side, because that's pretty low. And let's split the difference at 14%. All right, so I've sat there and said, listen, it's a $50 billion revenue company in 20 years, which some people would say is too low. Fine. But we're looking at a low side of 8%. What's 8% growth rate over 20 years? So I'm going to do 1.08 to the power of 20 times 1.8 billion, and we have 8.38 billion. That's very, very low for the company. That's very, very low. I got to think that's going to easily happen. So I'm being really, really conservative here, I think. All right, now, profit margin. Now, here's the issue with profit margin. We don't have profit margin in the company. All we have is cash flow. If you look at their income statement just shows loss, 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 loss. So that's very, very difficult. But we can make some sort of projections based on what we know about software businesses. For one, Microsoft has a 68% gross margin and about a 25 or 30% bottom line margin. Okay, Palantir's is a higher gross margin of 78 versus 68. However, they're still losing money. So we're trying to look at a 20-year average for the company. So I'm going to go a little bit, I'm going to be conservative. I'm going to go 12, I'm going to go 22, and I'm going to go 32%. All right. Now, this is the hard part of the stock analyzer tool. This is the most popular part of our site. 1.3 million uses of this software, of the stock analyzer tool in the last year alone. But the question is, when the company is losing money, how do you start with a stock analyzer tool that wants to factor in profit day one? So you've got to be a little more conservative and make some assumptions. Now, free cash flow margin. They already have free cash flow, so I'm going to be a little more aggressive on that one. I'm going to go 15, 25, and 35%. PE. So guys, when it comes to PE, You should go higher PE based on a high return on invested capital and a high growth rate. Now, Palantir is not the only company out there doing this, but they're growing very fast and they have a very good balance sheet. They can probably reinvest their capital at high rates of return. So the historical average for companies is 15, but even I would say I'm going to do a higher PE on low numbers because even if it grows only 8% a year now, it still has more growth rate to go forward. So I'm going to sit here and say, actually something I rarely do. I'm going to go reversed here. Because the bigger and bigger it gets, I think the less potential it has in the future on especially this company. And I want to be more conservative on this high side. I actually do here, and this is a very different thing that I do. So if you're new watching this channel and this is starting to make sense and how I look at companies as a business, please subscribe and watch our other videos on how I do the stock analyzer tool because every situation is different. I'm going to make different assumptions at different times. Now, finally, our desired annual return. Remember, this is basically your margin of safety. You can get 9 or 10% by investing in a long-term ETF. So in order to buy an individual company, you need to get a higher return. That gives you more margin of safety because the more return you have, the less you pay. However, Palantir is a little bit riskier than most companies. It's not a Microsoft, it's not a Google. So to me, I want a higher rate of return for a larger margin of safety. But the lower the assumptions, the lower margin of safety. The higher the assumptions, I need a bigger margin of safety because it's less likely to happen. So in this situation, I'm going to go with 14, 18, and 22% annualized return. Guys, I am absolutely butchering this thing, but that's my goal. For a speculative play like this, a company that isn't even showing a profit but has cash flow, and a lot of things can happen between now and 20 years. I don't know what's going to happen, but I'm going to hit the analyze button. Guys, the key here, I want you to remember, I absolutely want you to remember that investing is an art. If it wasn't an art, then people wouldn't disagree on things. But if you ask Charlie Munger and Warren Buffett what the intrinsic value is for Berkshire Hathaway, they've always said, we're going to come up with different numbers. If you ask my partners upstairs what I value our real estate and our businesses, we're going to come up with different numbers. That's the art of investing. And your assumptions here should be based on the way you look at companies. As long as you're consistent and always learning, and when you modify for good reasons, that's what we're trying to teach here. We're trying to teach you how to do that. So if that makes sense to you, and if you're a learner, you need to subscribe to the channel. And if you like the software, go to everythingmoney.com. We have a risk-free offer right now, money back guarantee. So check it out. So I hit the analyze button, boom. I have a low price of $2. I have a high price of $7.60 or $8, so call it $8. And I have a mid price of around $5. This is coming out very consistent. So guys, join the community. I'm sure there's people here. Go to everythingmoney.com, check it out, subscribe to the channel. It's very, very important. We want subscribers who are here to learn because you should do investing the way that makes sense to you as long as you have a fundamentally good process. Thank you very much for your time.